Hello and welcome. Good morning. You're watching KYC here on NDTV Profit. I'm Harsh Sahit. I'm going to be shortly joined by Mihika Barve because the company we're focusing on today is Deep Industries. It's into oil and gas field services. So in terms of the service supply chain, it covers 70% of the service supply chain. It was incorporated in 1991, so technically 34 years old, and it's an oil and gas service provider. It provides services like gas compression, dehydration, drilling, along with project management. And it also provides workover services and gas dehydration services. It also, last off, is an integrated project management service business also is something that it covers. So pretty much 70% of the exploration services in the entire value chain is covered by Deep Industries. Now, in terms of its clientele, prestigious clientele, before I come to the breakdown of these numbers, ONGC, Kane, Oil India, SR, Gujarat State Petronet, Gujarat Gas, as well as Adani Gas. All of these are some of the key clients of Deep Industries. Just to kind of highlight, all of the marquee clients that are out there are part of the client list for the company. Now, in terms of the business itself, that's the split in terms of, what's the kind of business services that they provide to revenue. And look at the margins of some of those businesses. Project management comprises just 20% of the top line, is the lowest margin business at this point, 27 to 28%. But look at some of the other, services that it provides and the kind of margins that it gets. Almost half the business is the 60% margin business. And that's what really stands out for me about this company. It obviously is one of the front runners in terms of the services it provides versus others, which is why some of these margins are currently sustaining. And therefore, that's the other thing that really stands out. While we are assessing all of these companies, we always look at performance parameters. Let me take you through the performance parameters that we'll be looking out for Deep Industries today. You'll have the income statement, you'll have the order book position, and this is going to be key because it'll give you some visibility on what next over the next year, 2 years, 3 years, whether that top line number and growth with regard to the income statement is sustainable or not. Then we'll look at the balance sheet and some return ratios as well. After that, we look at cash flow, shareholding pattern. We'll look at the street cred, the way in which the stock has performed. And we'll also look at the street coverage, how well analysts or how many analysts are actually covering the stock, giving us a lens into how widely covered the company is. Thereafter, we'll give you the full ratings and we'll give you a SWOT. So all of that coming through over the next maybe 10 to 15 minutes. Let me first off welcome on board Mihika Barve, who's going to help me break this down. Mihika, in fact, you're the one going to drive this more than me. Income statement. Yeah. Why don't you take us through that?
Yeah, let's kick off with the income statement. Sustainable growth, when you look at how it's progressed from FY22 to FY24, we have strong CAGR numbers in terms of your past 3 years as well. FY24, top line of around 420 crores, EBITDA 195 crores, and net profit of 125 crores. When you look at how it's moved, we have the double-digit CAGR numbers. Something that stands out is how its margins have expanded. FY22 stood at 37%, FY24 closed at 42.2%, and even if you see H1, FY25, we've seen an improvement, and that's because the business segments that the company operates in are high business segments, so it's a thumbs up on that front. The next thing I want to talk about is order book, and that's seen significant amount of growth.
Interrupt you there. Yeah. Before we head to order book, I want to focus in a little bit on margins because the way in which margins have gone up, 37 to 42.5. Just tell me, is it just the higher margin business that's coming in more? Is it the cycle? What's your sense on this one?
So the operations obviously very dependent on its key players and how they carry forward their oil and gas explorations.
Right.
But what they have is some of a competitive advantage because not a lot of players in the space. And when we've spoken to management, even in the past, they've talked about how they have a wide set of, operations in terms of what they provide. So you get the same clients kind of adding different orders in the different segments. And what gives them is because they have the assets in place, all they have to do is deploy. It takes a very short amount of period for them to deploy, and that's where execution takes place. And in general as well, because they have these assets in place, once all the fixed costs are taken care of, they have those margins to sustain itself. And they're also entering, like their project management, a less chunk, but it's something that is just entering. And they're introducing all these other segments where they have the assets in place, and then it all comes to how their order comes into place. So it's very sustainable.
But project
in that
management is the least in terms
because
of
it's
margins.
something that
If we can pull up the margins for viewers, if we can. So project management is literally 20%.
Yeah,
versus
because that's expected. It's still something that they're entering in.
Fair.
You don't know how margins are going to play out in that.
So you believe it might just come off from those highs, and currently they've been focusing on the higher margin business. Is that what you're alluding to?
So I'm alluding to the fact that whatever they are entering into have a healthy margins.
Fair.
They've never entered in something that has anything lower than 20% itself. So they are entering in, and while expected is 20% in project management, one of their main things, natural gas compression, where demand is set to only rise going forward, is 60% margins.
Fair. Because the numbers really stand out. So great perspective. Let's go to order book.
Yeah. So let's go to order book. We've seen significant growth. Q2 FY25, we closed at a total of 2,622 crores. And we've seen our orders come in even after that. When you even compare on a year-on-year growth, it's twice to what we saw in Q2 of FY24 at over 1,100 crores. And when you look at the Q4 of FY22, the order book stands at around 630 crores. So it's a thumbs up when you talk about from an order book perspective.
Mihika, one more thing I want to highlight here. Order book, and this really stands out for me. Order book 2622 crore, and you've got your top line of FY24 sitting at 427 crore. So such strong execution required on the order book.
That's right.
And I'll be really curious to know how quickly they can do that, because that will determine how this company pans out or what journey this takes over the next maybe year or so. Let's look at the balance sheet though, because that's where I come in. So 1,502 crore in terms of equity shareholders funds. This is of course equity share capital plus your reserves combined sitting at 1,502 crore. Your borrowing number is at 183 crore. So it's a very healthy balance sheet in that sense. And this is of course the combined borrowing number both on short term as well as long term. So no concerns there, and your cash balance is also sitting quite healthily at 50 odd crore, so 52 odd crore, and then you have investments, etc. Now, in terms of even price to book, and I want to just try and cover this because we've covered book value through equity shareholders funds. If we can pull that 1,502 crore number out, the market cap currently is around 3,650 crore. So roughly 2 to 2.5 times, maybe at best 2.4 times is what you're sitting on in terms of price to book ratio, if that's a number that one needs to track. But I just want to put it out there that that's the other piece from the balance sheet that I take out. But it's looking like a very healthy balance sheet overall. Mihika.
Then we have your return ratios. It's a neutral rating on this one. First of all, single digit ROEs, ROCs, no direct peers that we can compare it to. Obviously, their returns are dependent on how the main industry that they depend on, which is the oil and gas, kind of moves forward. We did see an improvement in ROEs in 2023, a dip, and current levels also very similar to what we saw in 2024. But the ROCEs, it is capital intensive in what their assets are getting invested in, we do see an improvement as per the latest numbers at 10%. However, how this would move forward, if this is sustainable at only this level, is something we need to, kind of get more perspective on. So it's a neutral rating on return ratios. But how are cash flows shaping up, Harsh?
Yeah, cash flows very healthy, Mihika. You're looking at your cash flows consistently have gone up. We've seen cash flow from operating activities on your screen from 55 crore in FY22. It's gone to 180 crore. So very healthy growth in terms of operating cash flow. And this is despite the fact that your receivables from FY24 have nearly doubled in FY22. Receivables have nearly doubled to in FY23. Despite that, we've seen a very healthy growth with regard to cash flow from operations. And that is also in some way related to the way payables have moved. Your payables have also gone up, and therefore there's been this healthy mix that they've been able to maintain with regard to working capital. They've also made fixed asset investments, and big chunky ones, both in FY23 and FY24, due to which you are seeing a slightly more muted number on the net cash flow front. So they've invested heavily, and that's what's really reflecting on the net cash flow. That's broadly how it's playing out. But overall, it looks like a very healthy set, especially when you're looking at operating cash flow. So a thumbs up from me on this one for sure. Mika.
Yeah. Then we'll look at the shareholding pattern. It's a thumbs up here on this. Strong promoter holdings, like you can say. We do have FI ownerships, not much of DI ownerships, but there is a lot of public or retail interest as well. We've not seen much of a movement if we've only seen higher FI interest as well for deep industries when you look at the quarter-on-quarter performance when you compare September to June. So it's a thumbs up on the shareholding pattern. And when you talk about the street credibility in terms of share performance, it's done really well. 1 year share performance, the stock has more than doubled. This was just from values a year ago. Even in 5 year, if you look at the 5 year picture, the stock has grown 28.57 times as of yesterday. And you know, that's a pretty good number in terms of how you're seeing your returns. Even in dividend payouts, your average 3 year dividend payout has been in the range of 12.2%, which is a good set of numbers. So it's a thumbs up in terms of your street credibility. And lastly is the street coverage, Harsh. A thumbs down on this one. We have only one brokerage tracking this stock, so not much of a perspective when you look at from your analyst or brokerage side. So whatever you know about the company is what you gather from management in terms of presentations, interviews, or earnings con call. So in terms of how the street is looking at the company, not much perspective from this. It's a thumbs down on this, parametric, Harsh.
Okay, so let me sum all of this up, because we've really clubbed together all of that information. Now you're seeing income statement, healthy growth, order book position. I mean, we saw that at nearly 6 times the top line of FY24 for the company. Balance sheet, again, very healthy. You're seeing decent amount of cash on the books, low borrowing, good amount of equity in terms of the base. The return ratios were a bit flattish, just about double digit, but also understand it's a unique industry. And therefore, we'll have to try and understand from management whether the return ratios can improve from here. So that's one question which I had in mind. The other one is cash flow from operations. Well, that's grown at a healthy clip. It's 3x'd in the last 3 odd years. Shareholding, also we had a large shareholding base with regard to promoters, 64% held by promoters nearly. Street cred, good returns, healthy returns over the last year, and even in the medium term, more in the medium term so. And street coverage, we don't have enough, and therefore is a thumbs down for us. It's a healthy 6.5 on 8 for deep industries basis our rating. But let's quickly switch over to SWOT, because that's where we'll try to identify what the concern areas are and what the positives are for the business. Mika.
I'll kick off with the strengths. It's a diversified portfolio of high margin businesses. And second comes your execution. Now, the company has stated itself that in terms of execution for certain projects, it takes 4 to 6 months versus what it would take other players in the field average of 10 to 12 months. So that's something in terms of execution where it has an upper hand. In terms of weaknesses, it does have high dependency on key clients. When you talk about your revenue generations from key clients from ONGC, as well as your order book growth. So it does have high dependence on a limited number of clients when you look at the total revenue or order book mix. And in terms of your revenue generation, it is all dependent on the successful execution of its order book. We have had some assets, seeing some delays and kind of halting the expected revenue generation. And then, like I said, the delays in refurbishments of key assets and order books. But lastly, Harsh, opportunities and risks.
Yeah, I'm going to take this very quickly. So one is your increased demand for gas compression services. Also, there's a large offshore market available. There's a strong bidding pipeline, as you can well see from the way in which the order book has moved. Risks, well, and threats, moreover. One is regulatory risks and threats. You could also see some bit of pressure with regard to crude, and that could well also impact deep industries indirectly and not directly. Also, contract exposure to foreign currency fluctuations, that could also be one threat possibly for the company. But let me welcome on board Rohan Shah, Director, Finance and Group CFO at Deep Industries. Rohan, firstly, good morning. I want to talk first about the latest order, ONGC. How large revenue potential and how quickly do you execute?
Sure. So the recent award we have received is for 100 metric ton walkover rig for a period of 7 years with an approximate contract size of around 90 crore. And we can mobilize these contracts within next 4 to 5 months.
Got it. In terms of, I also want to talk about the latest QIP, a 350 crore QIP that the company had accepted. What was the rationalization in terms of having this fundraise, and how is this going to be utilized as well?
Sure. So against our recent order from ONGC for walkover rig as well as for a production enhancement contract, we are expecting some good amount of capex against those contracts. Further, we are expecting some good amount of conversion out of our existing bidding pipeline, and putting all together, we are estimating capex of around 320 crores in next financial year. In addition to that, we are working on some good business expansion opportunities in an inorganic way, where we are discussing on some strategic acquisitions and tie-ups. There also we would be requiring funds. So putting all together, we would be in need of fund to the tune of around 500 crores, and of which almost or approx 350 crore would be raised through equity, and balance we would be utilizing through internal accruals and debt. So that's the primary perspective for raising equity and through QIP.
Fair point. And this 2600 odd crore in terms of the order book, how quickly will you execute that? 90 crore in a matter of 3 to 4 months will virtually be as much as your current top line is. So in a quarter, and therefore, how should one look at the 2600 crore order book pipeline that you have? How quickly will you execute that?
So out of 2600 crore, though today it has crossed 2700 crore now, almost 1400 crore order is for a period of 15 years. So if we exclude that 1400 crore, almost 1300 crore order book is to be executed over a period of 2.5 years. And the 1400 crore order is executable over a period of 15 years as per the contract. However, we are confident that we can execute that order over a period of 10 years or so.
And demand pipeline, does that continue to remain robust? How do you expect your order book to shape up maybe in the next year or so? You expect to win 1000 crore worth of orders. What's the pipeline like?
Yeah, so our bidding pipeline is quite healthy as of now, and we are continuously bidding various other projects as well. So the demand in the industry is exceptional, and we believe that it should continue to grow even for next 3 to 5 years.
Got it.
The way production enhancement contracts are coming, not only with our client ONGC, but with other clients like Oil India and Kane, we are quite optimistic that we should have few more such good contracts to be added in our order book in coming years.
Got it. You do have orders that, have a longer gestation period in terms of execution. So if you had to talk about how much of your order book could be, see actually revenue generation coming in FY25 as a whole and FY26, what are the kind of expectations on that front?
So see, our services are continuous supply of services. So when we are talking about executing order, our revenue is being generated on every day, every month basis. So as I said, the production enhancement contract has a longer tenure of 15 years. Other than that, my regular services contracts are executable over a period of 2.5 to 3 years. So against the 427 crore which we booked last year, we are quite poised to close above 550 crore in this current financial year, and it should grow more than 25-30% even in next financial year. So by converting the order book into revenue, we are expecting some good amount of growth, more than 30% for next 2 to 3 years.
Fair point. And how's the margin picture looking, sir? If we can also in parallel, I request the team, put up the margin numbers segment-wise so that gives good context for viewers. But what's the margin picture like? 40% sustainable? 39 odd percent?
Yes, in fact, we are expecting to improve on margin fronts as well. So with the change in focus from our traditional services to value-added services, we are now having major two verticals in our service offerings. One is natural gas and second is integrated project management. So both put together, we are expecting to grow at a decent pace, and overall at company level margin, we are quite confident that we would be maintaining EBITDA more than 40% going further as well.
Got it. You spoke about, adding, more value creative segments. And I wanted to ask in terms of the opportunity, in terms of chart hiring of gas, as well as your integrated project management services, which is something that you have just recently introduced. What's the opportunity here? And could you maybe give us in how much for these two opportunities, how could revenue mix translate? And what are the kind of margins you all are looking at?
Sure. So there is an excellent opportunity in charter hiring of gas processing. So we have recently provided a unique proposition by converting an EPC business into charter hiring by providing entire gas processing facility on charter hire. So I believe no one in India has provided such type of entire gas processing facility on charter hire, which has received an excellent response from key industry players. So we have successfully implemented such facility with Kane Oil and Gas and with ONGC as well. So we believe this can create a good amount of opportunity in coming future, where we are providing entire gas processing facility, which not only includes compression, dehydration, but it also includes separation, filtration, removal of unwanted carbon dioxides and all. So all put together, it's a complete gas processing facility, which we have started offering on charter hire. So it has a great amount of potential in coming time. Along with it, as you rightly said, with integrated project management, we have started providing services in a pool where we are providing walkover, drilling, hydrofracking, cementing, mud logging, all services put together as a single solution, which comes under integrated project management. So there also clients have started giving such good contracts. In fact, the recent award from Ceylon Exploration was for that integrated project management only. And that opportunity is also coming up in big way.
Got it, Ron. I want to go back to, your expansions. You've mentioned an organic expansion, a total fund need of 500 crores. You raise your 350. How will the balance be funded, and how do you expect your return ratios to, shape up going forward?
Yeah, so balance would be utilized from internal accruals, and if required, we'll take debt as well. So the return ratio will definitely improve going further, because the opportunities which we are eyeing, they can give us immediate boost to the growth of the company and overall revenue perspective. So in addition to capex for existing contracts, this acquisition can also helps us to take the business to next league.
Okay, very, very interesting. Thank you so much, Rohan, for joining us. Deep Industries has been a good deep dive. So from all of us here, thank you for joining us.
Thank you
for all of that perspective. Well, out of time on this edition of KYC from Mihika, myself, everyone who puts the show together. Thanks so much for watching. Stay tuned to NDTV Profit. More action right up on the other side.